What are holding companies? How can it save you tax? Well, check out this video as I go through all of the detail. Hi everyone, my name is Simon Misiewicz from Optimize Accountants. I'm here to help you grow your wealth whilst reduce your tax liability. In this video, we are going to talk about holding companies. So let's hold my hand as we go through this epic tax saving journey. Now, I need to set the scene of why people need to use holding companies. And the only way to do that is to give you a little bit of pain. Don't worry, I don't mean physical or psychological. I just mean the fact that you may be already doing accounts for your limited companies and already paying too much tax. And if that doesn't burn you, I don't know what will. So let's talk about the scenarios where people do pay too much tax on their limited companies. And let's base it on, we've got Janet and John, always typical that we use those names. So Janet, John, they've got a couple of companies. They've got an investment company on the left-hand side there, or your right-hand side, whichever way you're looking at the screen. And then you've also got these trade companies on the right-hand side. Now, these trade companies are not owned by them entirely. They are joined by joint venture partners. So they have got these joint venture partners that own this limited company 50%, and Janet and John also own 50% of these companies. Now, why is this a problem? Well, the thing is that each one of these limited companies may generate a whopping £100,000 profit. £300,000, why is that a problem? Well, it's not really, is it? From an income perspective, it's pretty darn good. From a tax perspective, oh boy, what a disaster we are heading up straight away. Let me show you why. The £300,000 will be split 50-50 because Janet and John own these profits, these limited companies between them, and they may have to now take this £150,000 worth of profits, which the joint venture partners are saying, I need to take my money, so if you don't take yours, you lose it. So £150,000 now goes over to Janet and John, and if they are already high rate taxpayers, that means that they could be forced to pay whether they take the money out as dividends or they take the money out in capital gains tax if they close down the companies. Either way, they will be high rate taxpayers and could have to pay this 32.5% as a high rate taxpayer on dividends, or indeed 38.1% as additional rate taxpayers. If they've closed down the company, they will also have this 28% capital gains tax liability, none of which they really wanted. They were quite happy to reinvest that money into the next deal. Unfortunately, they set up the limited companies to be owned partly in their own name. That is the costly mistake. Now, if you want to talk about growing wealth, saving tax, especially holding companies, then I've created an online community that does exactly that. It helps you to learn today to save tax tomorrow. And the thing about this community, it's got a bunch of templates. I'm there live every Wednesday to take your business, investment, tax related questions to help you structure things correctly. I've also got a number of videos, templates that can help you to do further research of how to save tax. Now, don't forget, there is a 7-day free trial. So make sure that you check out the link below this video and get hooked up and see me this Wednesday evening. Now, we're talking about limited companies, and we've got this £150,000, which I said before was going to go over to Janet and John. Well, in this case, the £150,000, the holding company at the top, the holding company will own these other businesses in terms of 50% shares. So they have this 50% shares down below, and the money would then flow up to the holding company. Please note that money that's going from one limited company to another will not pay any further corporation tax at all. because the company one has already paid its corporation tax. So you rip out the dividends after all the taxes have been paid. You send those dividends up to your holding company. No further tax. Brilliant. You've saved all that tax in one go. Now, clearly, there may be a time when Janet and John in this example have transferred the £150,000 into the holding company and they may wish to extract some money out of that limited company. And that's fine. They can make that decision. They can pay the income tax as and when they need the money, as opposed to just paying tax straight away because they've set up the incorrect structure. So we know full well that if you have a holding company and you pay yourself a dividend, that the first £2,000 worth of dividends are tax-free, which is great. You have, as a basic rate taxpayer, you pay 7.5% income tax on those dividends. High rate taxpayer does go up quite significantly to 32.5%. And then, boy oh boy, it goes up to 38.1% as additional rate taxpayers. So you really want to be careful about how much money you are going to take out of that limited company, because you could have an income tax nightmare if you are not careful. I have created a downloadable spreadsheet which you can pay for $9.95, and it tells you exactly how to extract the most amount of money out of your limited company without paying any tax at all. So make sure you check out that link below here. The link should also be appearing just above my head. So make sure you get that spreadsheet and save tax tomorrow. The one thing I do like about holding companies, now it could be a scenario where you have a holding company at the top and then you've got flip companies underneath it. And let's imagine that most people that want to flip properties, they want to sell those properties to the open market. Now, there will be times when you look at that property and you think, well, actually, I can't sell that on the open market for the price I want. So what do I do with it? Or you may look at that property and think, what a brilliant deal this is. I can get so much income from this. Why am I selling it? Why am I not keeping it? Well, the nice thing about holding companies, if you're a holding company, and in this example, we're going to say that the holding company owns the flip company 100%. Then what can happen is that this holding company owns the flip limited company. But if this got a property up here, which it would look better than this, I'm sure, if it's been done up, could move that property up from the flip company right up to the holding company. And as you would see here, it will pay no capital gains tax. There's no stamp duty land tax. And if you are converting a property that's commercial into residential, then that could potentially be a 0% VAT item, which means the flip limited company could also claim back the VAT. So it's an ingenious structure to use a holding company to save stamp duty, land tax, CGT, and value added tax by just understanding how holding companies can benefit you. As accountants, I'll see you again soon.